50-kilometer-per-hour scorcher. And what's in your hands? A plastic toy bat. It's not just a mismatch, right? It's a complete disaster waiting to happen. Well, what if I told you that this exact same scenario plays out every single day? Not on a cricket pitch, but in the stock market. And there it is. The cricket pitch is the derivatives market, and that plastic bat, well, that's the set of tools most retail traders are bringing to the fight. Every single day, thousands of people are stepping up to the plate, totally unprepared for the professional level game they've just walked into. So let's call this exactly what it is: the plastic bat problem. It's this whole issue of being fundamentally under-equipped, totally outmatched. Basically, you're set up to lose the game before you've even made your first move. Because here's who's on the other side of the field. You're not just up against other individual traders. You're facing massive institutions, the real pros. These guys have the best tech, mountains of data, and entire teams of experts who live and breathe this stuff. They've absolutely mastered the game. It's David versus Goliath, but David showed up without his slingshot. So what's the real-world result of this epic mismatch? Well, the numbers are pretty staggering, and they point to a huge misunderstanding about why so many people fail at this. 94%. According to the source material, that's the percentage of retail traders who lose money. Just let that sink in. For every 10 people who give it a shot, more than 9 of them fail. But the most important question isn't that they fail, it's why they fail. And here is the absolute key insight. This failure has nothing to do with how smart you are. You could be a genius and still lose your shirt in the market. The problem isn't intelligence, it's a lack of training. It's about being trained to see the real game that's being played, not just the simple version you see on your screen. This really shows the two different mindsets perfectly. The plastic bat approach, over on the left, is all reactive. You're just chasing prices after they've already moved. But the professional approach, on the right, that's proactive. It's about looking at the market structure to figure out why a price is likely to move, before it ever does. Okay, so how do you actually make that jump from being reactive to proactive? Well, it all starts with learning to look past the price chart itself and starting to see the invisible forces that are actually pushing the market around. This is the core idea. Just watching price candles go up and down is like watching the scoreboard of a game without ever seeing the players on the field. Sure, you see the result, but you have no idea why it happened or what's likely to happen next. So the first pro tool is something called Orderflow. Think of it like a thermal vision camera for the market. While the price chart just shows you where the ball landed, Orderflow shows you the intensity of every single move along the way. It literally reveals who's in control, the big institutions or the retail crowd, by showing you exactly where the big money is being thrown around. And the second tool is Market Profile. Now, if Orderflow is the thermal camera, Market Profile is the blueprint of the entire building. It takes all that trading data and organizes it over time to show you the market's structure, the zones where the market has accepted a price, and, just as importantly, the zones it has rejected. This is how you start to understand the game plan, not just the individual plays. And when you combine these tools, the source says that a really fundamental shift starts to happen. You stop being a follower, chasing every little price jump, and you start to become a leader. You're not guessing anymore. You're anticipating what the market might do based on its structure and the intent you're seeing. And you can really see the shift in what people say. Take Mukesh here. He says he was blindly following price, but now he can spot when the big institutions are making their move. But notice the most important part, and more importantly, when to stay out. That's a professional mindset right there. Sometimes the best trade is no trade at all. And then there's Rishab. He calls it the missing link. That's that idea of market structure we just talked about. He finally understood why his trades were failing at the same spots over and over. Suddenly, a frustrating loss isn't just a loss anymore. It's a value.
Good afternoon, everyone. Good afternoon, everyone. We are here to talk about order flow today. Before that, can I get a few visual confirmations that you guys can hear me clearly? Right, that looks like everyone is on board and we are good to begin. So we are going to be talking about order flow today. And today's webinar is not going to be about anything in terms of what the market is doing tomorrow or on budget day or everything else. We are here to simply talk about how to make sense of the data which is coming to us. And for that, we always have an order flow chart which has got more answers for us than most other analysis tools we use, including the ones from Market Profile and NTM Wallets and the Gamma, Density, etc. Different ways of interpreting data. Here is one chart on screen which gives you a transparent understanding of what is happening at every single point in time in the market. So this is what we call an order flow chart, and the order flow chart is simply this particular chart with the numbers on a screen. So if I have to blow this chart up open, the first thing you would see immediately on this chart is that this is a set of two numbers, right? You got a set of numbers on the left hand side and you have a set of numbers on the right hand side, and together they are what you call an order flow chart coming to you. So those numbers, the ones on the left would be always in red, and that is your supply coming into the market, and the ones in green is your demand coming into the market. So always two numbers in the market at all times, not just one price in the market, two prices in the market, and you recognize those two prices as bids and offers. Now this is the foundation of understanding order flow, that there is always two prices in the market, and price is a negotiation between the bid and the offer, and the output of that is what you traditionally call an LTP, last traded price, or the final price, which is visible on screen. But to get to that output, you still have to go through a process of choosing whether to be on the bid side and the offer side, or the offer side, the bid side or the offer side. And when you choose, you either contribute to the demand side or you contribute to the supply side. So we say always in markets that markets are a conversation between demand and supply, and reading that conversation is essentially what understanding the marketplace is all about. So that conversation, which runs every single minute, every single tick, every single 5 minutes, every single 30 minutes, that is what we are going to be talking about today, and trying to see if we can get a little bit more in terms of clarity. Because when it comes to the world of markets, clarity is a tactic, okay, which needs to be had, and everyone should have it as their strongest option. The more clearer you are, about the way you interpret data from a chart, your understanding of what is happening in the market, the clearer is going to be your understanding, your process, and the final output, your trading result from that equation over there. So clarity is a tactic. What we do is we see, we confirm, and then we act. So in doing this, in seeing, in confirming, in acting, there is no amount of guesswork which is involved. It always has to do with data on your screen. This is not a business of hope. This is not a business of guesswork. This is not a business of doing a maybe. It's about reading the tape. It's about respecting data. It's about leaving our egos behind and understanding that every single trade is got a stop loss and a target and an entry point. And once that entry point of yours is finalized, you've got to know, okay, when you're going to be exiting if that trade of yours is wrong. That's the reason we have a stop loss in place. And you have to know when you are exiting, when you started making money in that trade. That is when you say that you are making profits in the trade and you're booking the outcome of that trade. So we're going to be talking about all that. So to begin with, the left side of the screen is always going to be supply. The right side of your screen is going to be the demand, the green, and you need to read these numbers real time in a moving market. And one of the first things we say about understanding order flow is to understand how price moves in the market. And price moves only when either a buyer or a seller shows intent. Now, this is foundational. This is the bottom line. So if a buyer and a seller is putting two limit orders in the market, a buyer puts a limit order, a seller puts a limit order in the market, and there's nobody else, there's no third person in the market, price cannot move, price will not move. There is no condition for price to move simply because there are two resting orders or two limit orders in the market. Price only moves when either the buyer or the seller agrees to enter a market order and meet the seller, the buyer meets the seller at his price. There is some kind of intent shown on the part of the buyer, and he agrees to meet the seller at the price in which he has put the order on the screen. And that's the time you say that there is a trade which is happening. So that intent, that initiative activity of his, that aggression is what we call in order flow the reason for price to move. And tracking this intent over a period of time is what a reading of an order flow chart is. So it's not like, you have one buyer going up to one seller at one point in time, and then that's a demonstration of intent. That's one tick, and one tick is not going to move the market. So what we try to do over here is we try to measure this intent in terms of the bars or the minutes on your screen. So intent has to be shown by either the buyer or a seller over a period of, say, 1 minute. Intent has to be shown by a buyer or seller over a period of 3 minutes. And intent has to be shown by a buyer or seller of over 5 minutes, 15 minutes, 30 minutes, depending on that case. And the longer the duration the intent is shown by the buyer or the seller, that's the time the signal is a lot more stronger than the previous one. So we call these signals of intent as IB bars, or initiative buying patterns on the part of buyers. And intent shown by supply or sellers, we call them IS, initiative selling candles of the market. And tracking the intent of the market is what the entire understanding of order flow is all about. So we keep this tracking this intent as a sequence. You would immediately come to know how far price can go and how much it can move. So that's one of the reasons we keep an order flow chart open, to track real-time intent in the market. And the more you get an understanding of who is driving that intent, whether it's a buyer or whether it is a seller, then clearer is your understanding about what is happening in the market. So I'm just going to share with you a chart which is of the Nifty futures of today, just to quickly demonstrate to you what this signaling of intent is. So intent starts a move. Remember, without intent, there is no movement in terms of price behavior in the market. So every time, okay, you see intent, you got a condition in place for the price to start making a move. And like I said, an intent shown by a buyer is classified as an IB3 candle, or an initiative buying. IB means initiative buying. In a 3-minute time frame, we would call this an IB3 candle. So the significance of this is that the entire candle is showing intent over 3 minutes. And for us, that is substantial rather than, watching that intent over 1 or 2 or 3 ticks. So think of this as you're going to a gym, and you have a trainer with you, and you are doing some kind of a shoulder press or some kind of an exercise, okay, where you're pulling weights, for example, and you pull weights one time. Your trainer tells you it's good, but to build muscle, your trainer will tell you that you have to do 8 repetitions, or you do 10 repetitions, or you have to do 20 repetitions. And the person who can do 20 repetitions is considered stronger than the person who does, one of those moves. So that's why we track this over a period of 3 minutes. So that means intent is shown over consecutively. It's shown intent over a period of 3 minutes, not just one particular tick in the bar. And over 3 minutes, if that intent is seen, then we put a condition in place where we say we are going to be buying over the highest point of that intent of that particular bar. So that builds a condition for us to be net buyers in the market. For example, 25,411, 25,380 is the low, and this is what we call an IB bar. So this bar is telling us that this market was flat for a period of time. Suddenly someone came in and showed intent over a period of 3 minutes. And what we do is we try to enter a buy side trade when price goes up about 25,411, and we put a stop loss below the low of the bar, which is 25,380. So 25,411 is our buy price, 25,411, and 25,380, 25,380 is our stop loss. Now, why is this important, and why are these numbers just not a random piece of mechanic which we have on tape? Now, the reason for this is an entry because we are buying where all the people have bought previously. And just to make it easy for ourselves, we are buying when the high of this bar is crossed. And what we are assuming, and I'll use that word assume over here, what we are assuming is that all these people who bought at this particular location between 25,380, they will defend price from going down further. Why would they defend it? Why would they defend? Because they are the ones who are showing intent, INTENT. And because we have seen intent and we have seen a demonstration of strength by buyers, this becomes a classic case for us to buy into a market. So that stop loss of ours is protected. 25,380 is our stop loss, 25,411 is our entry, and we buy above this, and this market rockets up to about 25,480 in about 20 minutes time. Why does this happen? Because intent is the driver of price. This is condition one. This is not the only thing on our charts, but this is one of the easiest way to understand how to be ahead of the market and read an order flow activity. I'll give you a few more examples about how best you can read this intent, and you can read it across charts. You can read it in your puts as well. All you have to be clear about is how you understand the messaging which is there. So let's take one example from a put early in the morning. So let's me zoom to the left of the side and today's example only. So today we had a classic down move in the first 80-90 minutes of the session, and then a market put in a low, and we had an up move. So let me go to the morning today. So I can do that by quickly doing 9:15 over here of today, and let me see if I can get this 9:15 bar of 25,500 PE over here. So 25,500 PE, put in an IB3. This is the same thing which we just spoke about. So the IB3 was 352 early in the morning. Stop loss was 316. This is a sign that there is some intent by put buyers in the market. This is a 2500 P, and we can make it any one to see if there is a similar intent in there. You can use it for any particular instrument as well. So 25400 in this case is not showing me intent, but the better way to do it is a lot of the big money will operate in the money puts and in the money calls. So in this case, you have one at 954 at 341, and you're making it a point to buy above it. So in this case, this is not yet triggered. Let's go back to that example of 25500 PE, because that's an example which was triggered. Now, why is this not triggered? Because we have to buy above the IB bar 341. In this case, 341 is not triggered. But to use an example of a trade which was triggered, we go by the 25500 PE, and we put that same condition in place that we are going to be buying above the intent of the bar. So that's 352, and the stop loss is 316. And if you pan right, this is a trade which went up above 352 right up to 412, and the stop loss of the trade was not violated at 316. So 352 entry, 316 stop loss. The trade has gone to 412 in about 25-30 minutes. Now, why is this happening? This is happening only because there was a sudden rush of intent in the market. Aggressive buyers came into the market, and these are the people who drove market lower and the put higher as a result. So these are all those buyers who came into the market, and they are the ones who quickly pushed price to a higher level. Again, this is a classic trading framework. So if you're the kind of trader who tells yourself that I am going to be buying at 350, but I am going to put only a stop loss of 20 points because I do not trade for more than 20 points in the market or for any one trade, you are actually disrespecting the flow of the market, and you're trying to put the entire market in a box which you have made yourself. So that's not the right way to trade markets. You have to be a lot more fluid. You have to be a lot more flexible when the market is moving, when the market is not moving, when the market is doing what it has to be doing. You cannot put the market in a box and say, here, come, sit in this box, and now I'm going to carry you and do what I have to do with you. The market needs to be treated with a lot more respect. And because a lot of traders do not treat the market with respect, they end up losing to the market. So what we are placing over here is a condition for entry and a condition for a stop and a condition for a target. The entry has to be the high of the IB bar. The stop loss has to be the low of the IB bar. If you think that is too much, then you do not take the trade. As simple as that. But you cannot put a random number as a stop loss, because randomness is the result of a lot of quick losses in the market and of a lot of rapid losses in the market. Every time you're random, every time you do not follow a process, you open up yourself to making a lot of losses in the market. So if this is not acceptable to you, you do not take the trade at all. If it is acceptable to you, then you have to trade as per the process and as per the outcome or the outline which is in front of you. So 352 minus 316, that's a roughly 40 point trading range. 352 minus 316, it's a 40-point trading range. Your stop loss is gonna be 316, and you look for a 1:1 reward. So that's 352 plus 40. You will be looking for a target of 390, and you would get a reward which is at 412 over here, which is exceeded that particular target. Right. So this is how you track intent in terms of the activity of the market. I want to stay with today, and I want to quickly show you something interesting which happened today, and I put a tweet out also on this. So let's go back to the Nifty futures. And let's look at the activity from the open today. So from the open today, we saw a lot of 25,410 was the open today at 9:15, and right off the open we saw a lot more red on the left hand side against green on the right hand side. So it's always a message to you that supply is overpowering demand, and because you saw all this, market dropped. But have a look at what really happened as the market dropped, which was around 10:15 a.m. You're just seeing the opposite over here. So there was this 1426 buyer who came in somewhere around 9:45, 10 o'clock, and a string of greens had come in between 10:15 and 10:45 in the C period, which is 10:15 to 10:45 a.m. Now, if you're looking at this chart, this is telling you this is not a signal for you to go long. Remember, the signal for you to go long is to track intent of the bar. There is no IB over here. But when you're looking at this, you're understanding that there is no longer supply in the market to push prices lower. So remember one thing as a golden rule, and I mentioned this earlier also, the market is a negotiation between demand and supply, between people who are buyers and people who are sellers. And every time demand is higher than supply, price goes up. And every time supply is higher than demand, price goes down. In this case, you're seeing a lot more green than red. So there is no supply in the market and there is no incentive for the market to go down below 25,262. So because of this, an IB3 later formed and we started moving this. So this green is all yesterday's sellers and morning supply closing, and because they closed, supply went off the market. Supply went off the market, gave a chance for new demand to come back into the market, and which is why we rose from 25,260 to 25,560, a gain of 300 points from 10:15 to 10:45. It started from here, supply closing, and it went right up to about 25,560 it was, where again, okay, some profit booking happened, and the market, okay, moved lower after that. So that 25,560, all that green started booking out over here, and this is why you got this particular signal coming out over here, right? So that's 2546 booking over here, all that green booking, and these are all intraday traders which booked out over there. You can track this via call option also. And the same time frame, and look to see if there were any kind of IB. So when the futures show you some kind of demand overpowering supply, you look quickly in the money calls and see if you can get any kind of significant initiative buying, initiative supply coming back over here. So let me go to the same period today around 11:15. Okay, so around here, around 11:15 and 25,200 calls, we saw IB3 269, 248, but it was not activated. We did not put in any buying about 269 for the next 10 bars. So this was not active at that point in time. We turned right, and we got another IB around 12:45. So this was activated now at 268. And because it was activated, we put a stop into the system, which is 244. So you buy about 268, you put a stop below 244, and you let the market run till either you hit a target or you see the next IB3. Now, what is important for you to notice over here is that this is not a signaling system. It is in a way, but it is also, and more importantly, it is also an indication of intent shown by fellow people who are driving demand in the market. So this, if you are looking to buy into the market and there is already some other buyers in the market, other demand in the market, then you're placing yourself into a stronger demand side move of the market. So again, to repeat, your entry is 268, your stop loss is 244, and you look for a 1:1 gain. So that's about 24 points. And when that 24 points is come, if you do not see another IB, you book. If you see another IB, you go back in again, 269 stop loss, 285 is the entry. You buy about 285 with a stop loss of 269. But have a look at what really happens in this 40-minute window between 12:45 and 1:06. There are 3 IB signals, and each of the lows of the IB signals are protected. Who is protecting them? Previous buyers of the market. They do not want that trade to go into a loss. That is why their trades are, their stops, their entries are going to be protected. So it makes sense for us to keep our trade aligned with that signaling out over there. Now, what's happened in this particular window at 299, there is an IS3 which is coming. This IS3 has come in. This IS3 has come in after the 314 IB3, which was not executed. Now, there are a couple of things which are happening over there, and I'll come to this in a bit. But this IS3, there are 2 things to note about this IS3. One is this IS3 is not active. Why is it not active? Because we have not gone below the lows of the IS3. So what has happened in this case, this IS3 is simply those early buyers booking profits. So they have booked at market, and that's why this is a profit booking candle. If this would have gone below 279, you would have entered into a long put over here. The other thing which is happening is you see these zeros which have come in the IB candle. This is telling you that there were no new buyers as price approached 314 in this 25-200 CE. So every time you see a lot of green inside the order flow, that is telling you that there is a lot of big buying which is happening. But the opposite of that is also true. Every time you see a zero print in a order flow intent candle, or for that matter any other candle, that is a sign of no demand. And every time an IB candle or an IS candle will show you zeros, that is a sign of no demand in the market. And every time there is no demand in the market, you do not want to be buying the market at 314, because the rest of the market is not buying. You should not be buying over here. So this 290, this 661, this 287 are all people who are booking profits, and there is no new demand coming in. So every time, okay, you see this price candle like this, 314 with zeros, this is the time you start taking in terms of profit. You start taking profits in the market. So on and on. If you follow this as a complete process, this is just the core beginning of understanding order flow. But there is a lot more you can do with an understanding of an order flow chart. Order flow chart not restricted only to an entry or an exit or a stop loss or a target. It's more about understanding where the market wants to trade and who are the big traders who are trading at every single point in time. Right. So I'm going to stop here, and I don't want to talk a lot about order flow without the basic understanding of why you need to have an order flow chart cleared out. I do hope, okay, this is informational and it helps you understand an order flow chart better. I just want to quickly summarize what I spoke about. Order flow is a transaction between demand and supply seen real time. There are 2 prices in the market at all times. and an understanding of what is happening between the two prices, the negotiation between demand and supply, is all that we need to understand when it comes to the world of order flow. In any order flow chart, the left hand side, the red font, the pink font will always be your supply. The right hand side will always be your demand. Your candle is still there. We have not taken the candle out. These are all your candles. We shift the color of the candle to the left. Well, what we do is, instead of focusing on the color of the candle, we go and look at what is happening inside the candle. And when you look at what is happening inside the candle, you understand why this candle has printed this high and why it is held this low. You also know, okay, why it opened at one end and why it closed on the other end. Right? So this is one way of reading the market, reading and understanding of the market. You keep it clean with an order flow chart. You track intent. It may be a little bit difficult for a lot of traders who are focused on price plus indicators. This is a shift away from price plus indicator kind of thinking to a thinking which is led by demand and supply. And anybody who trades markets will tell you that the markets are a function of demand and supply only. That's the baseline. That is a proper understanding and a look at how markets actually work. Demand higher than supply is the reason prices go higher. Supply higher than demand is the reason prices go lower. And if you can have that base level understanding sorted in every single time frame of yours, the 3 minute, the 1 minute, the 30 minute, the 1 week, the 1 day, the 1 month, the 1 year, you would have most of your equation of the market sorted. So I'll pause over here. If anybody's got any questions, please feel free to ask pertaining to order flow. We'll keep it restricted to order flow. The rest of the questions, we have other sessions. We can talk about it in the other sessions. Any other questions on order flow? I intended this to be for only about 20-25 minutes, but this is a topic which is very dear to me. So I overshot, and I hope that is not an issue for any of you. If you need a bigger understanding about how we work with order flow, I've just come out with a print copy of a book, Power Trading with Market Profile and Order Flow. And this is a workbook which is currently on our website. I call this a workbook. I don't call it a PDF because a workbook is intended to stay at your desk. The market is not something which you start off at one page and understand everything in about 300 pages or 160 pages. So this needs to be understood in a live market, and you can have this for yourself as an ebook, and all that I spoke to you about is already covered in this ebook. The charts which I brought to you are there at charts.vtrender.com. So I took the entire charts from here. We've created the entire order flow suite back up from scratch, and the elite one is got the entire order flow, exactly the same charts, okay, which I spoke about, already covered up over here. So you go into the menu, and at the very top you would see the order flow. And this will tell you exactly, okay, about what is happening at every single point in time. Right. A few questions have come in about NPOC and all. That's a big topic. I just covered today intent, and I covered about how to use the zeros at the end of the tape. The zeros were covered in a text post. There is a lot more to speak about order flow in terms of LLT, large lot traders. There is a lot more to speak about order flow in terms of zero prints, in terms of NPOC, the naked point of control. We will cover all of that step by step, maybe in another session, which we intend to do very shortly. So I hope, okay, this is helpful. And if you need to get good at order flow, I highly recommend that you do the order flow replays, especially at the close of the session. The order flow replay is there in the menu. Just press on the order flow replay button and replay the day, you'll get a clearer understanding about how you can read the world of order flow. So thank you all, okay, for joining up and being a part of this session. I hope it was helpful and can definitely help you to put some more actionable trades in the market. All the very best to you.